What's going on, guys? Brian's here. Now, unlike a lot of my other videos, this one is specifically about a trade in which I took on October 25th of 2021. I swung the trade from that Monday into the following day, which was October 26th, 2021. Now, I want to let you guys know that a 900% return, or about $6,000, is how much I made on this trade, is by no means a normal return. It is an outsized return because it was an outsized move. So I want to prelude that just so you guys can have a little bit of a realistic expectation. I know a lot of new traders see this type of stuff online, which is usually why I don't like sharing too much of exactly how much has been done with this or how much has been done with that, because it kind of creates a false sense of expectations, I think, for newer traders. And there's a lot you have to discover on your own in your first year of trading before you can even look for these types of moves. But there's a lot that can be learned in terms of understanding how another trader might think about something or how another trader prepares, because I think that's one of the ways in which I learned the most. I think the YouTube channel that I really appreciated, and I watched their contents a lot my first couple of years of trading, which was SMB Capital. I highly recommend their YouTube channel and just the approach in which the traders approach every decision that they make there. And it makes sense because it's a professional proprietary prop firm in New York City, and they're known internationally for trading and training a lot of younger traders and turning them into more seasoned traders. And the co-founder, Mike Bellafiore, his book, the Playbook and One Good Trades, the Playbook is one book that I would highly recommend any trader getting into the market, because it teaches you to be able to ask yourself certain questions in terms of can you answer, why did you take this trade? What did you see before you took this trade? What conditions met your criteria for when you're looking for your entry or your exit? And as opposed to just, scalping or just hopping in and out of a trade, which I'm not an aggressive scalper. I like to sit back and look and wait for certain situations to hit. I'm more of a situational based trader, I guess you can say, and I look for certain criteria. I'm also more of a quantitative trader. I'm the lead developer of Quant Trading app, and I use more of a quantitative approach to my trading. So one of the reasons why I knew this trade would have worked out as well as it did, or not necessarily no, I just had more confidence or more conviction in it, is because I knew that there was data backing the trade. Now, against newer traders, there's this big concern about market makers, and I know the perception is that they're just there to mess with your mind and manipulate the market as well as stop you out, and then price goes flying right after you get stopped out. But the truth of the matter is, market makers are a necessity to the market. They provide liquidity, and that is their main obligation towards the market. And they have these obligations because without having the market makers easing the concerns of an illiquid market, the market in a sense would struggle. It's the fact that we go into the market every day as it opens, in the stock market specifically, we have confidence and we have faith that if we want to buy something, there's always going to be someone willing to sell it. As well as if you're trying to sell something, there's always somebody willing to buy it. If you went into the market and you didn't have that same, you didn't have that same confidence that there would be somebody on the other end of the trade, it would probably keep you away from coming to the market. Just think about this in your normal sense. So the market maker's function is to be there to service the needs of us as traders. Now when we talk about the options market, it gets a little bit, there's multiple levels to it, but I'll try to keep this a little bit of simple as we get into the concept of a gamma squeeze. If you buy a call, that means you're increasing your delta. If you didn't know that, delta is one of the primary Greeks tied to an options contract. If you buy a call, it means you're taking on a positive delta position. Now, what does that mean? It means every time the underlying or the stock is increasing in value, so is your call option. For the most part, we're taking aside, we're not considering the other Greeks like volatility and stuff like that. We're just going to focus on delta for now. So if you buy a call and your delta is 0.30, a 0.30 delta, that means every time the stock goes up $1, your call is going to increase by 30 cents, which is $30 in your pocket. But we have to think about who sold you that call. There was a market maker more than likely attached. It could have been any other option writer, but for the most part, it's more than likely going to be a market maker. They're the ones that are there to sell any type of option, and it is their role to do so. They don't necessarily have much of a choice because they get a lot of perks for being market makers, but the downside to having all of those perks means they have to service our needs. So in a sense, they're kind of a slave to the market. And if there's a lot of demand for a particular call option, they have to be there to make sure that they're selling these call options to meet that demand. But they're taking on what's called a negative delta position. If you buy a call, your delta is plus 30. That means the market maker is negative 30. They can't go home at the end of the day with a negative delta position. Their algorithms are very complicated, and it's engineered to actually offset their delta risk. And that's in a sense called delta hedging. So if they were to sell you a call, that negative 30 would mean they have to find some somewhere else to offset that by creating a positive delta position. Therefore, their delta becomes zero. So they're necessarily taking on no directional risk overnight. The simplest way for them to do that, if they were to sell a call on Tesla, means they have to buy Tesla shares. So they buy the shares equivalent to how much negative delta they have. Hopefully that didn't confuse you guys. I'm trying not to speak too fast in this video. I know sometimes on my webinars, I have a tendency to go a million words per minute. It's because there's so much information which I'm trying to jam pack into a small time frame. And when I first started trading, I wish, especially options, I wish a lot of this was explained to me, as it would have helped me have higher conviction or higher, deeper understanding behind why price was moving the way it did. And if you didn't know, the options market largely controls what's happening with the actual stock market. And there's certain reasons why things happen by expiration that just seems weird and stuff like that. There's so much money involved in the options market, and because it's time-based, it's not one of those things where it's like, oh, just set it and forget it, like maybe long-term investors might do. When you're taking on an options positions, you have to really consider what's going on with the Greeks or what's going on by a certain time. And I don't necessarily just mean retail traders. I mean the guys that are operating on the levels of billions of dollars. So I'll reiterate this one more time. You buy a call, your position is positive delta, right? You'll have a plus 30 delta in this case. If a market maker who's on the other end of that trade sold you that call, their position is negative 30 delta. However, they buy 30 shares. Therefore, for every 1 point the asset goes up, the 30 shares increases by 1 point. So therefore, they'll make $30, but they'll lose $30 on the call that they sold you. So therefore, they're not really taking on any risk. What happens in this particular case for Tesla, this Monday, in which when it gapped up, I know that it gapped up over a level that has never gapped up over before. It was an outsized move for Tesla. And I'm not necessarily the type of trader that follows much of the news or the fundamental catalyst behind driving what's happening with, short-term price movements. In this particular morning, it had a good catalyst. It was the Hertz news that Hertz was ordering, I forget how many cars for the rental service, but that was just, it was cool to know, but honestly, it wasn't the driving factor behind why I was interested in this trade. It was the fact that for the entire year, Tesla has never made this type of move on a Monday before. And that's the type of information that I use quant trading app for, is to understand that this gap up had never happened from a Friday into a Monday, and the information was very easy to see. So that means that the market makers were not prepared or properly delta hedged for a move like this. And if you take a look at the contract in which I traded, it was the 1000 call, and Tesla had gapped up, I think it was like 950 something, and had closed the previous week. I believe it was below 900. We'll take a look at the charts at the end of this video. I'll probably show, screenshots and stuff like that on this video right here. But I wanted to do this video talking specifically to you guys, as opposed to putting up, behind the charts and showing you guys on the screen, because I figured if I did that, this video probably would have been like 2 hours long, because you guys know I like to provide a million different situations and examples and screenshots and stuff like that. And I figured if I just talked, I'd be able to get it out to you guys a little bit sooner. And there's also a reason why this video is coming out in December when the trade happened in October. It's because I've just been extremely busy, and I'm trying to do a lot more videos in which I just talk to you guys, because these videos are just a lot easier to do. It's just turn the camera on and just start talking and just kind of doing an information dump on you guys, and hopefully I organize it a little bit later with examples. But if we get back to the example on hand, in this particular case, the market had not expected Tesla to make such a move like in which it did. So I knew the market makers would be more than likely in pain, because that type of move was not prepared for it. The 1000 call had an open interest of 8,000, if I remember correctly, on that Friday. And as it gapped up, it was so close to 8,000, the delta was like less than 15 or so. But at the time, by the time it opened, it was like high 20s or something like that. So that's something to take note of. I was not aware of it at the time in which Tesla had gapped up exactly what the delta was. So I just wanted you guys to understand it. It's just knowing that it gapped over this specific level. So I waited for it to pull right back to this level from quant trading app. Now, if you're not using quant trading app, or you don't have some other type of quantitative method to trade, take note of what I said there. I didn't buy this call option just because Tesla was gapped up and it was like, on its way to the moon, because the contract it actually pulled in a little bit, which is why I suggest if you're a new trader, please don't trade options the first 10-15 minutes of the day, or don't put on much risk if you're going to trade it. Risk maybe $50, $100, and even that to me I think is too much, even if you have a $10,000 account for the first 10-15 minutes of the day, because what that does is it psychologically throws you off if you take a quick loss. And if you're a new trader, you don't know how to psychologically recover recover sometimes from starting your day off with a bad trade like that. And there's not that much edge at the beginning of the market unless you have a decent amount of experience and you know exactly, your pattern recognition skills are amazing. And as good as I like to say my pattern recognition skills are, I still don't feel that confident at the open unless I have some sort of quantitative data, a quantitative edge at my back, like knowing where a stock has never done a certain situation before. So I watched Tesla pull right into this level, and that's where I got the contract long. It was the 1,000 call going for $6.50, and I instantly notified, everyone in the Discord, in the quant trading app Discord. I was like, guys, I just got this Tesla contract here, and it bounced up to VWAP. Now for a day trade, that was great. It probably went from like 650, I think, to like $8, $9. So you could have scalped that, but not being a scalper, it's when you scalp, half the time you end up not focusing on the bigger picture, and you end up taking profits so fast because you're conditioned to do so. But if you enter the trade already labeling what type of trade it is, it was a trade to hold, which is a concept that I got from SMB Capital in the books and watching their videos. It's the fact that you have to have your reasons to buy, your reasons to sell, as well as your reasons to hold. This was an outsized move for Tesla. The market makers were not prepared for this move. Therefore, it's very likely to enter what's called a gamma squeeze. And the gamma squeeze would be, a gamma is a contract's rate of change for delta. So, okay, I'm trying again not to get too complicated with it. So if delta is how much the option will increase as the stock is moving up, gamma is the rate in which the delta will increase. So what happens in a case like this, because Tesla gapped up so much, the market makers were forced to sell more calls because there was so much more interest and demand for Tesla. But by selling more calls, they have to buy more shares. What ends up happening is the rate at which that's happening, it's so fast that it's not necessarily offsetting their risk. So they end up buying so much shares as they're selling calls, and then at the end of the day, you see that more open interest will increase because they have to sell more calls. But again, for every call they sell, they have to offset that risk. And if that's happening very fast, it's not something that can necessarily be prepared for. What ends up happening is the implied volatility increases so much that the price of the call that they sell ends up offsetting their risk. But the situation with Tesla was that its implied volatility actually wasn't that high. It was only a few days prior they had earnings, and after earnings is when the implied volatility drops. The large move happened, so it's not expected to make another large move. And the fact that this happened so fast just after earnings, I believe it was like 3 days later, 4 days later or something like that, this type of move was not priced in. And you can take advantage of that, of when you're aware of when certain moves are priced in and when they're not. Again, it was a little bit easier for me because I had the level on my chart, as well as I knew the information from quant trading app. But that aside, you can use some sort of other technicals to maybe, I'm not sure how you would, if you can, if you knew exactly what's the average gap up on Tesla, if it ends up being 2% and then it's a day that it's up 6%, you can pretty much use that as a gauge, especially if it's not an earnings gap, because earnings gaps are usually baked into the option prices because the increased implied volatility. Now, in this particular case, it was the perfect storm of the fact that the implied volatility was relatively low, especially since it had just come off of earnings. It was the fact that it was a gap up on Monday, knowing Tesla has never gapped up that high on a Monday for the entire year, meant the options chain, because of the way things are structured using the Black-Scholes model, everything is priced in on a yearly time frame, which is why options expire at the end of the week. It's a 52-week cycle to simplify that concept. If you've never thought about why are options expiring every Friday, it's all based on, if you've ever heard of the Black-Scholes model and how that's calculating implied volatility. Now, if the implied volatility doesn't match the move, market makers in a sense can get caught with their pants down. So again, I'm not sure how complicated. I've been talking to newer traders a little bit more now, and the level of traders in which I talk to a little bit, they have the traders in which I know, the friends of mine, they have like 3 times more experience than me, so I can talk to them this way. And I'm now talking to a little bit more newer traders, so I don't know if certain things get lost in translation, so please let me know, guys. And I could have this conversation for about 3 hours with a couple friends of mine, and we pretty much all kind of get it, again, because we have a few years under our belt, as well as we have friends that are trading for 10 years and so, and there's so many new traders entering the market that are not necessarily aware of what's going on with this. And the interesting thing is, now everywhere you look, everyone's saying like, oh, this is going to be a gamma squeeze, or this is going to do this, or this is going to do that. And it's largely because our minds have expanded and have opened up since the rush of all these new traders into the market thanks to the pandemic. And a lot of that is also pertaining to crypto. Like we've seen moves happen, couple thousand percent, 3,000% returns in the crypto world. And those crypto traders are also looking at the options market and also looking at the stock market. And there's a certain expectation that everything is going to be a gamma squeeze because we had GameStop move this year. We also had AMC make the large move that it did this year. But it's about the understanding of the conditions that it takes to make this type of move happen. And I'll actually be doing another video because Tesla recently did. It was the perfect, most beautiful trade opportunity as it put in the all-time high. It broke out again and it retraced back to 900, and then Tesla had a great week last week. I think it was up 10%, but it was another perfect recipe. The implied volatility came down. It came, there was a lot of technicals reasons for the trade. There was a lot of puts that were sold and it gapped into all those puts that were sold. Meanwhile, the price of calls were relatively cheap, so the skew was perfect. Like there's just, when you can understand and see the full picture here, you end up realizing that there are a lot of amazing moves that happen in the stock market, but it takes training your mind to be able to spot them, as well as the patience and understanding not every single move you take or every single trade you take is going to make that type of move. You have to understand before you get in, is this trade, does it even have the potential to do that move? And for the trader that I'm looking to become, especially next year as I evolve, every year I do as a trader, is about understanding that now that I can see these types of moves or see the moves that are expected to do this, I'd much rather save my time and energy and spot those trades and put more risk on them. Because of this particular trade, I bought this contract for $6.50 and I sold it for $67.50 the next day. I knew to hold it again because Tesla was only at 950 or something like that, 940 something at the time in which I bought it. But it was going to, it just made sense for it to hit 1,000. The open interest went from 8,000 to 18,000. They had to write 10,000 more contracts. The delta jumped from, I think, 0.12 to 0.30 in a heartbeat, and that thing was going for 0.50. If something goes from 0.10 delta to 0.50, as the stock is increasing, the market makers have to keep offsetting their risk. That's the other thing that's not necessarily, again, a lot of this is not really talked about or discussed, or it doesn't get enough attention. But if you were to sell a call to me and your delta was negative 30 and you buy 30 shares to offset your delta, as that stock increases, if the delta becomes 50, you can't just sit back and let that happen. You have to offset that risk as a market maker, which means you have to buy 20 more shares. And as that call becomes in the money, you're offsetting that risk from the time in which you sold it. And then if implied volatility is increasing also, you're also really at risk. And this is all what's known as convexity. And I'll pause there, so I feel like I'm already starting to ramble a little bit and get a little bit too complicated with it. But to summarize, guys, it's about the patience and knowing what criteria and conditions to look for and wait for, as well as lowering your expectations when these types of moves are not there, and then knowing when they're likely to come and knowing to maximize them. Because a same trade like this 6 months from now, if I see the same conditions in which it hits, it's probably going to be about a $40,000, $50,000 trade for me, and I'll probably be using maybe $2,000 to $3,000 in capital, because I'm also a very risk-averse trader, which means I'm not the type of trader that puts $50,000 on a scalp trade to make like $2,000. To me, that's ridiculous. When you can sit back and be able to spot an opportunity where you can use maybe $1,000, maybe $500 and turn it into $5,000 if you train your mind to know what to look for. But then it's also about knowing that this doesn't happen every single day of the week. If there's 4 quarters in the year and I'm constantly looking at least 20 tickers across the entire year, my watch list doesn't necessarily change. I'm aware of the fact that at least every quarter, one of these stocks are going to make some sort of outsized move. And then on top of that, there's 3 months in every quarter. So if each ticker gives at least one trading opportunity for the month across 20 tickers and there's 20 trading days in a month, it's not all going to happen, every single day. It might be spread across certain weeks. So train your mind to reduce the quantity of the trades you take and look for the quality setups. Use some sort of quantitative information, even if it's simple as like looking up as like, hey, what's the average time Tesla does XYZ. I don't know where you can get that type of information or whatever, but I'm pretty sure it's out there. Go to Yahoo Finance. Just try, please, guys. Just use some sort of quantitative edge and more information or data, as opposed to just like as opposed to just like, oh yeah, it was like a bull flag and like I scalped it for, you know, 5 points, and it's like, but the total move was 50 points and you caught 5 points. And I'm not, again, it's nothing wrong with that. If you've been doing that for a while and you're very consistent with scalping, I commend you. It does not work for me. But if you're a newer trader and you've already been doing that for so long and you've been struggling, and you have to understand that that's not the only way to make money in the market. And you don't need to make more money by taking on more risk by using like some crazy size on a scalp. You can actually make a decent amount of money if you're using something like spreads. There are a ton of butterfly spreads and calendar spreads that are relatively very safe to take, and we're talking about you can still get the same type of returns, but you don't have the risk to theta. You sometimes don't even have the risk to vega. It just depends on how you structure your trades, and it's just a decent amount of information out there. So I'll conclude this video here. Leave the comments down below. I have a lot of catching up to do in the comments. I'm hoping to get around to that in about a week or two, as I've been really coding a lot. I'm spending a lot of my time more so as a quantitative developer now, because I realize the more information and the more data and stats that I have, as well as historical context, it's very easier to spot outsized moves before they happen. So that's kind of my journey right now. And for those of you guys that look up to traders like Deep FM Value from Reddit, who caught the GameStop squeeze when he started buying. Guys, he didn't make those millions of dollars on that trade and start this whole phenomenon by scalping. He did his due diligence. He researched what was going on with GameStop. He started buying call options that expired a year later. He was using spreadsheets. He was tracking the information, tracking the data, and understanding a trade like that can change your life. There are trades like that that happen every month in the stock market, and using just the high beta stocks. I'm talking about the companies that everyone knows if you trade options. Facebook, Amazon, Tesla, Netflix, Google, Apple, Nvidia, AMD, Roku, Shop. Like these tickers, you can have a watch list of 20 stocks for 20 years and never, like, you just need to change maybe one ticker every year, and don't overwhelm yourself by always chasing a million different things. Just look for the quality setups. And if I'm not sure necessarily how I'm going to edit this video, so if I haven't shown any examples on this chart as I've been talking, I'm going to hop behind the computer right now and see if I can find any examples, or if there's anything else I'm going to show you guys. I'll do that on the computer right now to show you exactly the entry that I took when I notified the Discord, what it looked like on the quant trading app levels, as well as the entry and the exit. And my reason for exit, by the way, is because I was up 900% and I was already deep in the money. And I don't know if you know anything about, if you're deep in the money on a Tesla contract, I'm talking like 50 points in the money. Every dollar Tesla was moving, the P&L was insane, and I was already up pretty much 10x, and it was more than content. It didn't seem worth the risk to hold that option anymore, so I was more than comfortable to get out, even though the contract would have been worth $110 by that Friday. So it would have been, you know, turning $600 into $650 into like 10 grand, which is possible, 11 grand. But it was about understanding, did I capture more than half of the entire full move? In this case, it definitely did. So I rated the exits pretty good in my opinion. So catch you guys in the next one. Thanks for watching, and later.